Good morning, everybody, and welcome to this edition of our Weekly Think Tank for Monday, 17th of May. My name is Carl Capoligua, and I'm the market analyst over here at Think Markets Australia. It is a pleasure to be with you as we chat about the big events from last week and have a look to the week ahead. We'll do that after we talk about the Think Markets difference, which is substantial, $8 flat rate trades, your own holder identification number, unlimited phone support, and of course, no hidden platform or subscription fees. Four fantastic reasons to make sure your next ASX share trade is with Think Markets. And if you are new to the Think Markets family and you'd like to sign up before June 30, get trading, first 5 trades for free on us as well. As is generally the case with these things, there are some terms and conditions, so head to the website for further details. The agenda for today is to check up on what's going on around the traps in markets, including a crypto update. We'll check out some of the key macroeconomic data from last week. A little bit of a twist on the focus sector this week, more on that later. The ASX value insights of where is the value in the Australian market right now, and some very interesting data on the technical analysis side of things as well. And then we'll finish off with a look at the week ahead. Kicking off with the crypto update here, we'll talk about Bitcoin first. It hasn't had a fantastic week on the back of you-know-who, Mr. Musk, tweeting again. Last week he said that Tesla would suspend payments for Teslas by Bitcoin because of the energy-intensive nature of Bitcoin mining. Now this is, it seems, only news to Mr. Musk. It has not been news to anybody who follows this space, because we know that Bitcoin is a very energy-intensive mining process. If Bitcoin mining were a country, it'd be around about Argentina. That is about 26th on the list. Massively wasteful exercise is Bitcoin mining. Effectively, you have a bunch of very sophisticated and very energy-hungry CPUs crunching away at this cryptographic algorithm. Each miner's mining rig, they call it, is trying to solve the same equation at once. When one of them eventually does, that validates the next block in the blockchain, and they are rewarded with some Bitcoin. Much of that mining also occurring in China, about 60% of it, depending on what day of the week it is, and most estimates are that at least half of that coming from coal-fired sources as well. Now, Musk has said that it's not the end of his interest in crypto, simply that he would only consider far less energy-intensive projects as future payment options for Tesla, and then in subsequent tweets indicated that maybe Dogecoin could well be one of those. Bottom line is Bitcoin prices taking a tumble. He also tweeted over the weekend, but it was in a very sort of indirect way, that he indicated that Tesla could well dump their entire holdings of Bitcoin that they've built up over the last few months. So chaos and maelstrom in the crypto space more broadly, because it spread to the other cryptos, as we'll see on the next screen. Ethereum not having a great end to the week as well, because they have a very similar protocol to Bitcoin. Both cryptocurrencies use what is called a proof of work stake, which is basically what I mentioned before. It's very, very wasteful. The future is in other methodologies like proof of stake, consensus, and there's a few other complex things going around. One of the least energy inefficient cryptos is Cardano. These guys, depending on which think tank you read the research for, are about the third least energy inefficient cryptocurrency. So in comparison, that's Thursday there, where Musk comments come out, and you can see the difference in the price action as well. So I'll just quickly go back and we'll have a quick review. That's Bitcoin. We've gone from what is clearly a demand-side market into more of an equilibrium market. So this is where demand is greater than supply. Here it's pretty clear that demand has become equal to supply, and we appear very close, if not that we already have moved into this supply-side market where supply is greater than demand, and the rallies are smaller, the falls are bigger, and who knows from here. Bottom line is, I've been saying for a number of weeks now that this has been the developing situation, to be cautious with your Bitcoin holdings. I have spooked for quite a period of time now also that Ethereum is a better alternative. Yes, it is that proof of work protocol, but they have a plan to move away from that with Ethereum 2.0 that will probably be completely enacted within the next couple of years, and that will make it a far less energy intensive protocol, and certainly I'm expecting anyway it would tick the boxes for Mr. Musk. And another one which looks very interesting in the space is Polkadot, ticker code DOT, which again is another very energy efficient protocol, which also, much like Cardano and Ethereum, supports smart contracts and decentralized finance. Okay, so just a quick recap there. Bitcoin on the nose, no interest in pursuing that one. Ethereum, the trend is still very strong. I would be happy to stick with it if I had it. If I didn't have it, I just want to see how it responds in this short-term trend zone here. I'd love to see some positive candles in here. They would probably look something like this before I got too excited. But the trends are still great. Stick with it. And Cardano, I'm happy to be a buyer of that one. Again, if you get a pullback, I think that's a bonus, and I'd be looking for the right candles in that zone. Polkadot, I think you've got time to get involved in this one if you're a bit more aggressive. Any pullback to 40 is probably the entry point. Otherwise, if you're a bit more conservative, you might want to wait until it actually breaks through this 50 zone with some confidence. So at least a close above that zone first. Okay, back to boring old shares. The ASX market down for the week. Repivot now to inflation data. So inflation data, both in China and in the US, came out worse than expected. We'll talk about the details in a second. But it hurt Aussie shares after a very strong Monday. On Monday, we got to within 27 points, I think it was, of our all-time high. And the data spooked markets. More on that to come. For now, just noting that the ASX 200 down about 1%, All Ords down a little bit more than that. Worst performing sectors, without a doubt, information technology, as the buy now, pay later sector continues to suffer after pay with some big losses over the last couple of weeks. Material sector pulled back, as did commodity prices. Some news there also we'll talk about soon. Property also down, as was utilities, which is the worst looking sector anyway, no surprise, and telecommunications. I note energy not doing so well either. A few on the upside though. Healthcare up 0.76%, very interesting looking sector. Staples bouncing back a little bit after the Woolworths sell-off a couple of weeks ago. Volatility, that's a big spike though, isn't it? 28% to the upside. That just shows nerves. It shows that investors want to be compensated for some of these uncertainties that are around at the moment. The uncertainty hit here with the release of the US CPI and PPI data, which backed up some negative data out of China. And that was just after Monday. We got to 7.172, which was only 27 points from that all-time high. The trends are still intact. Short-term trend still remains up. That's a good sign. Long-term trend is also up. I'm concerned, though, about these three supply-side candles here. Generally, when you see them, it can just flatten trends out. I mean, look here. This is we saw them appear here after what was a really good run, and they don't have to end the trend, but they can certainly signal that supply has reached the market. Supply has reached what was previously a demand-side market. And we get this little equilibrium where supply and demand become equal, then it takes some time for demand to take over again. We're only just starting to get there, again, where demand was greater than supply. So if anything, look, we may see a period of sideways movement. We don't want to see any more of these. We don't want to see lower peaks coming in. These would all be negative signs that at least the short-term trend is switching back to down, and we'll come back and test this long-term support zone down here. So we'll just let the price action tell us, what the demand supply dynamics are. In the meantime, I don't think it's a panic just yet, but be very, very alert. Having a look around the world, that's a big drop there on the Nikkei. I haven't followed that story, so I'm unsure as to why that is, but that's concerning as well when you start to see global markets fall that much in a week. Having said that, Shanghai Composite was up 2%, and I have seen that chart. That actually looks quite good. So let's maybe just take that with a pinch of salt for this week. Not great to see US markets down quite decisively there. NASDAQ down the worst. That's the risk on market. So when that's underperforming, that's also concerning. And volatility spiking up into the high 20s on that VIX, but it did settle down towards the end of the week. That's encouraging. Europe pretty quiet. S&P 500. Now we talked about this these supply side candles, the incidence of these supply side candles, and when you see them, they tell you that supply has arrived. And if you're in the demand side market prior to that, then it demonstrates that we are moving probably into some sort of equilibrium, and then it's a question mark whether you go back to demand side after that, or supply in fact hangs around and persists and then pushes us into the supply side market. So we don't know which scenario is going to play out. But what I will say is this: when you see these bearish candles, these supply side candles, the best thing for the market is to get that ground back as quickly as possible with some white candles. We didn't really see it. I'm just going to switch back now to the Aussie market on Friday. And if you look at Friday's candle, it's pretty pathetic in here. So it tried to rally and we closed well off those highs, potentially because, hey, it's just Friday and that's what we do on Fridays. But it's not a great response to those black candles as PowerPoint finally catches up. So if we go back to the US, we can see Thursday, Friday, some nice moves here. So that, I think, demonstrates that on a relative basis, the trend in the US is far more sustainable than the trend in Australia. Moving along to the NASDAQ, also a nice response on Friday. That's encouraging, but far more damage done here in terms of this short-term trend. So much, in fact, that the moving averages, I'm pretty sure they have crossed over there to indicate we are now officially in a short-term downtrend. Long-term trend is still intact, so happy to stay with this sort of risk-on bias until I see otherwise. But with these lower peaks and lower troughs in place, it's not until I start to see high peaks and high troughs that would indicate to me that we are moving back into this, risk-on environment. Okay, having a look at commodities markets for the week, they were down, and quite convincingly so. Aluminium over 3%, as was lead. The rest of them pretty close to that. Zinc down nearly 3%, iron ore down 2.5% in China, but not as bad in the US dollar price, still managing to eke out a gain there. Copper was down nearly 2%. The only thing that really went up was steel, and there are some sort of localized supply and demand issues going on in China at the moment. Gold got a small bid size. Silver was fairly flat. This is the iron ore price in China, coincidentally, and there were some comments here from Premier Li that the Chinese government is going to continue to crack down on speculators, on manipulators, on rumour mongers, on those trying to rig the stainless steel market, probably more specifically, but also how it flows into higher iron ore prices as well. And that caused a bit of a pullback. But even then, they were on these candles that had very long lower shadows, which indicates there's still plenty of demand in the system. And we did see a bounce off that 50 level, which is important as well. So, look, I can't see anything too sinister in here that wouldn't suggest that the longer term trend is going to continue, and even the shorter term trend is still very much intact on that basis as well. This is the iron ore price in US dollars that trades in Singapore, and we can see a far more modest impact there. In fact, it still eked out a weekly gain, and this is still an amazingly strong trend. So if you are on those miners we've talked about over the last couple of weeks, I can't see anything too terrible there that you need to be overly concerned about. Having a look at the gold price now, we mentioned it did have an up week, albeit very small, and when these inflation expectations are about, gold tends to shine, pun intended, but it's not shining that much at the moment. Yes, it has made this nice double bottom pattern here. Yes, it seems to have moved back into higher peaks and higher troughs. Yes, the candles are beginning to look a little more whiter than they were previously, but it's a pretty anemic rally in my opinion, and still kind of downtrendish here. Look, until we get back above this level and we really start to put in some nice white candles and increase in volatility, there's really very little volatility in here still, and nothing really in here to suggest that people are coming in a big way into the gold market. So this is still a question mark for me. I think if you're a gold bug, look, the moves are definitely positive, but there's not enough in that chart to suggest that some of these inflation expectations are really ratcheting up, certainly not to an extent that would hurt equities going forward. Energy slightly higher there. The Australian dollar was weaker as the US dollar rallied more broadly, albeit very modestly. And bond yields were up, bond prices down on the back of that inflation data. We saw the Aussie 10s spike from about 1.6 at the end of last week into that 1.75 range. Sounds bad. Certainly we don't want bond yields to go up too much because it will significantly undermine the valuations of equities. But nothing, we didn't see anything like this. So this is the adjustment, the initial adjustment to, hey, there's going to be some inflation down the track. Now that the data's starting to come in, look, it's not fantastic that we're starting to see this move up because, hey, is it the start of this and this and this, which replicates this? But it was pretty modest, wasn't it? So I don't think markets are convinced yet that things are going to get horrible on the inflation side of things. But hey, I think we need to be very alert. Another reason why we need to be alert is, yes, in the US, we did see a far more protracted, a far more acute response to that inflation news with a move up in rates. But encouraging to see Thursday, Friday, those black candles come in to just moderate that, that short-term uptrend a little. But hey, short-term trend is up, long-term trend is up. We need to keep an eye on things. We don't want to see this sort of continuation here. That would be bad for stocks. Also bad for stocks potentially is history repeating itself. And we talked about it last week. Last week we were right at the top of that orange line, and we said, hey, this time versus last time, well, if we're going to continue to follow last time, and the orange line is the current recovery, and the red line is the GFC recovery, if we are going to follow the red line, then this is where it starts to get really bad. And that's last week. So fingers crossed we don't do that. There's no reason why the orange line should follow the red line. It's just a little bit of fun we have on Monday morning, so don't go sell your portfolio simply because of what happened last time. Okay, having a look at some of the data, I'm checking also my time, and I'm so far behind. So I'm going to whiz through these very quickly. Australian retail sales look better than expected and certainly up from the previous reading. So that is very encouraging. Having a look at the Now Business Confidence Survey, hey, also very encouraging. Definitely the trend is your friend there, and businesses feeling really confident about their current situation at the moment. So we've got confidence rising from 16 to 26 and current conditions from 23 to 31.75. This is the data that sparked the sell-off, or at least the start of the data, because we'll look at the US ones in a second. CPI in China came in at 0.9%, and that was way ahead of market expectations and way up on the previous month. But to put it into perspective, we're still way down on where we were at the end of 2019. What's a little bit more concerning, though, is the spike in producer price indexes, because typically this one leads into this one, right? So this one on the right is the precursor for the one on the left. Businesses are facing higher costs, so then they pass them on to consumers. Came in at 6.8%, way ahead of expectations and way up from the previous one, and you can kind of start to see why markets got spooked. Not helping things, but less focus on this week, was the fact that new loans and money supply continue to decline in China, but that is more to do with government pullbacks in spending and stimulus than anything else. It's more of a managed move, so I don't think markets are too concerned about that. Here's the US data, 0.9% on the consumer core versus 0.4% expected, so a massive blowout there and well up from the 0.3%. And on the producer side of things, also higher than expected. Look, most of this inflation is on the supply side at the moment, okay? It's not due to overwhelming demand at this stage, and the global economy still has plenty of capacity because of COVID. And just to put this in a nutshell here, central banks are more worried about the demand side inflation than they are of the supply side inflation. Supply side inflation tends to be transient. Once supply comes back online, the price increases tend to ease. Okay, so central banks won't be too concerned at this stage by the inflation that we are seeing because of what's causing it. But hey, it's something to continue to monitor. Retail sales in the US came out flat. That's why you can't see them at the end there, which was worse than expected. Consumer sentiment also dipping towards the end as well. Having a look at the jobs front, some improvement here. So US job openings, hires and quits. Orange line is the openings. They shot up to just over 8 million, way ahead of expectations and up from the previous month. And we've also seen an increase in the hires, which is obviously great. So there's openings, then you need to hire somebody, and a small blip up, but an important blip up in the number of quits. And that's how you know when the job market is really starting to improve, because people are comfortable to quit their job with the confidence that they're going to find another job somewhere else. So that's a big tick for the US economy going forward, and we did see some improvement there in the weekly claims as well. Okay, here we would normally talk about a focus sector, but not today, because there isn't one I can really put forward to you as an area to go and find bargains at the moment. It's not the case. The S&P ASX 200 is in a short-term uptrend and a long-term uptrend at the moment. We saw that, but the short-term uptrend is being challenged. As for the rest of the sectors, financials and materials are the only other two that are still in coordinated uptrends. The rest of them have some sort of uncertainty about them. For example, the discretionary is in a neutral short-term trend, but a well-established long-term uptrend. And really, unless I can get 2 ticks in the box, I'm not prepared to go shopping in a particular sector. And certainly if I get 2 crosses, that is a sector you want to avoid. So utilities, we're talking information technology and energy are still sectors to avoid at this point. Promising, I'd say healthcare looks half interesting here with a short-term uptrend, and we're waiting for that long-term trend to switch back to up. And property trusts also look quite interesting as well, with a well-established long-term uptrend and just a pause in the current short-term uptrend. So no sector buys from me this week. Looking at the value in the market, we're at a PE of 18.1 on the 1-year forward ASX PE, and that compares favourably to the rest of the world, but that spread has been narrowing a little bit over the last few weeks. In terms of the cheaper sectors, materials still looks like the cheapest, then energy, then financials, way out to IT, which is less expensive than it was a couple of months ago, but still eye-wateringly expensive at nearly 60 times price to earnings ratio. This is probably the most concerning chart I'm going to show you today, because this is the participation of stocks in the bull market, and a healthy participation level is around about here. So somewhere between sort of 60% and 2/3 of stocks participating in uptrends. And these are trends based upon 5 periods, which is 1 week out to 1 month, 21, 2 months, 3 months, 6 months, a year. So where is the current price of the stock in relation to those moving averages? When the price is above each of those key timeframes, it's very positive for the stock. When there are a majority of stocks in that situation, then that's positive for the market more generally. We are currently showing less than 40%, so only just over 1/3 of stocks sort of out to a month are in an uptrend. That's concerning for me. It does get better as we go further out, so the long-term trends are still up, but short-term trends are being challenged. Now, we've talked ad nauseum this morning about this idea of going from demand side into equilibrium and then question mark, where do we go from there? We're kind of here, all right? We don't want to see this switch into something that then impacts on longer and longer term trends as you go further out. So long story short, something's not right with the market when you get to within 30 points of an all-time high, and this is the breadth, the participation in that rally that we're seeing. Having a look at the week ahead, we are going to have unemployment data this week in Australia on Thursday. There are some other ones there, but that will be the most important one. And looking to next week, it's actually pretty quiet next week. We do have a data dump from China today, and then really just the FOMC meeting minutes, pretty quiet otherwise. Thanks for joining me this morning. You can catch all of our other updates in our market news section of the website. You can follow me or the Think Markets handles if you like on Twitter. Tomorrow, we will be hosting our top 3 stocks under 30 cents webinar. So make sure you go to the webinar section of the website to register for that. You must register, and then catch us for Ask the Experts next week. And then in a couple of weeks from now, we'll be doing another Think Learning session, how to use price action to spot trading signals. And I've no doubt I'll be drawing lots of these charts. Okay, that's what that session's going to be about. If you want to understand all of these supply and demand dynamics that we've talked about today, definitely tune in for that one. Okay, the disclaimer before I leave you today says that the content of this presentation is general in nature. We are a regulated Australian broker. We do have some products that could see you lose more than your deposit. So before acting upon any of this general information, please read this disclaimer carefully or give us a call. It's been a pleasure chatting with you this morning. All the best for your trading until we catch up again. Bye-bye for now.